Hi, I'm Frank Gruber. I've put together this series on reading escrow statements because I'm a do-it-yourselfer and I know a lot of you are. So sometimes it's helpful to have a YouTube video show you just a little bit more of what you need to know to possibly continue doing your own tax returns. Many of you have been preparing your tax returns for years because it's been very simple. But this year, maybe you bought a house, maybe you sold a house, and you get the closing paperwork back from the escrow company and there's all kinds of numbers there. You know that somewhere in that paperwork there's some hidden tax deductions, but where are they? That's what this series is designed to help you figure out. Although it's not legal tax advice, it is a good guide on understanding the basics of how escrow statements work. By understanding the basics, maybe you yourself can pick out those hidden tax deductions. I hope this series helps you. If you have any suggestions, please leave it on your comments. Thank you. Let's dive right into closing escrow statements. Those two terms are used interchangeably. Closing statements, escrow statements, they're all identifying a transaction. In this case, it's the sale of a home residence. Typically, they're several pages long. It has itemization of closing costs. It's got a summary of the transaction. I always get to this page where it talks about the selling price of the property. That's when you know you're at the heart of the escrow statement. If you look at this section, you'll notice that there's a left column, borrower's transaction, and the right column says seller's transaction. Now, the format may be slightly different on some escrow statements. You may have just the borrower transaction on one sheet of paper, the seller's transaction on another sheet of paper, but you're looking at the same big concepts. Let's talk about the big concepts in terms of the buying and selling of a home. What's typically happening from the borrower's point of view is that he's putting money down and he's taking out a loan to get into the property. From the seller's point of view, he's typically selling a piece of property. He's going to pay off existing mortgages. He's usually going to pay off any sales commissions to the real estate agent, and he's getting the balance in cash. That's exactly what's happening here. We start with the heart of the escrow statements. I know when I'm getting to the heart where I see the sale price of the property. That's really our beginning point, whether or not you're looking at from the borrower's point of view or the seller's point of view. So let's start with the buyer's side of the equation. First of all, this top section, there's two sections here for the buyer. There's also two sections for the seller, but for the buyer, it's these two sections. The first one says due from borrower, and that essentially identifies what is he legally due to come up with to get into this property. We see it's made up of the $300,000. That's the buying price or the selling price. Those are logically the same thing. And it's also comprised of any closing costs he has to pay, as well as any property taxes he's got to come up with. So total on closing, remember we're always looking at a closing date of a particular date. This is a summary of a transaction that occurred on a specific date, and the transaction is also always consummated on the closing date. So the closing date of this transaction was 12/18/2015. Going back to our heart of the transaction, we know that the borrower's got to come up with $304,792 to get in. Okay? The second half of his side of the column identifies for us on the date of closing what has he come up with and how has he come up with it? Well, he's come up with what he owes to get into the property by putting $15,000 down. He's taken out a $200,000 loan. So of the amount that he needs to come up with, the $304,792, that amount's also down here, he's come up with on the date of closing of $215,025. There's also another miscellaneous credit here we'll talk about later. But the balance between what he had to come up with and what he's already come up with is $89,767. That's the amount of cash he's got to come up with on the closing date, when they're going to closing. That's what he's got to present a check for to come up with additionally to get into the property. If we look at it from the seller's point of view, it's the same transaction, it's just a different point of view. What's the seller want to know? Well, the first part of his side of the equation identifies for us what he wants to know. I want to know, what am I legally due to get? Well, first of all, he's legally due to get the selling price, right? So, and he's also allowed to get some county taxes that he's prepaid. We'll talk about that later. But essentially, what he's legally due to get is the selling price of the property. Does that mean that we're going to cut him a check for $300,000? No, because standard industry and practices say the contract structure so that there's certain deductions that are going to be taken out of that money before he sees any of it. And what are those deductions? Those are identified in
the second part of his equation on the right-hand side of the column, and those deductions are going to be the closing costs. In other words, the real estate agents get paid first out of the proceeds. Okay. Next, out of the proceeds, any mortgages on the property are going to get paid off. There could be a first, a second, an equity line, et cetera, et cetera. That's just standard industry practices, contractual contracts for selling real estate. Those are things that are going to be deducted from the seller's proceeds prior to him seeing a dime. Okay, there's also a miscellaneous $25 we'll talk about later. But of the amount that he's legally due to get, minus the deductions that they're legally going to take out, is what he's legally due to receive on the date of closing, a check for $156,096, or essentially the equity in the property. Okay, so this format has got the borrower on the left, the seller on the right. Sometimes you'll see the borrower just on, this is all on one page and this is on a separate page, and the borrower's the top part will be on the left side of the page, and the bottom part, what he's come up with so far, will be on the right hand side of the page, and the difference will be what he's got to come up with the closing. On the seller, it could be all on one page. The left side would be what he's legally due to get on the sale, and what on the right side of his page would be what is being deducted, and then the difference would be the cash he's getting at closing, which is essentially the equity he had in this property. That's the cash he's going to walk away with. So that's a summary of the heart of an escrow statement. When you get to this section where you see sale of property, you got to ask yourself, okay, I'm at the heart of the closing statement. Now, am I looking at the borrower's point of view or the seller's point of view? Keep in mind that if the buyer pays all cash, then he's not a borrower. But typically, 99% of the time, people buying homes, they're going to borrow money to get in, so they call them a borrower. Borrower, buyer, same thing. Okay? So now that you know the heart of the escrow statements, you can zero in on these items and eventually pick apart what is tax deductible that I can pull out of these statements so I can put it on Schedule A, itemized deductions, on my income tax return. We'll get into that because it's different whether or not you're looking at the seller's point of view or the buyer's point of view. So we'll get into that in another video.